Okay, it's over. Sell it all. It's March 20th right now, 2026, and I'm just kind of giving my thoughts on the overall economy. So here's the overview of what this video is going to be about. And fair warning, I am doing this all in one take. So if I pause or kind of have to recollect my thoughts, put it in two times speed. You'll be all right. But yeah, I want to break down each risk I see in the US economy right now with factual data. I'm going to try and make it as uh, little speculation as possible. And then I want to go over the implied conclusions from that data that I have, as well as go over some of the counter arguments and why I do think they hold up or don't think they hold up. And then a big part of this is I want to explain non-isolated risks. So people will look at one individual section of this video, and when they're typically going into the weeds of it, they sort of act under the assumption that this is happening in a vacuum. It's happening independent of everything else going on in the US economy. And I think it's all super interconnected. And so whenever I see all of these different risk factors all kind of combining for one big negative cycle, I get a little frustrated whenever the risks are dismissed on just one of them. Okay, and then the conclusion, the very end, I'm going to explain kind of what you should do. Maybe talk a little bit about what I did, and how you should prepare for this overall. So I want to start off with the debt sector. I tried to do this in a way where you establish the context for everything else that's going on and kind of go over the more complicated stuff at the end. So overall context for the debt sector, I want to make this very high level, not get into the weeds very much. So just kind of look into this on your own. But we had COVID stimulus, and that was to sort of reduce the burden and strain from COVID, pushing prices up, give people some cushion. But what it ended up doing was boosting a lot of credit scores, giving people money that they otherwise wouldn't have had to spend on loans, and particularly auto. They bought a lot of cars around that time. Student loan payments were paused, and they weren't being reported. So if you weren't making your student loan payments, that wasn't being reported to the credit agencies, and so you've got a little boost in score. The way that credit works is it's meant to go up and down very quickly. You start making payments on time, have good habits, you get rewarded very quickly, and if you miss a payment, you get your points docked down really quickly. So this big stimulus package sort of has a big impact on credit scores and makes a lot of people seem prime when they're actually subprime. Other debt sectors had reporting accommodations. This goes into greater detail if you actually look at the CARES Act, but essentially under certain criteria, other places where you weren't paying on your debt on time wouldn't be reported as well. And then I just kind of want to go over this big theme of extend and pretend. So essentially, people aren't able to pay their loans. They can't make the payments, and instead of recording that as a default on their books, they'll modify your loans. They'll do reporting tricks that I won't get into to make the numbers seem a little bit better than they are. But here are some of the actual numbers, and you'll see like if you break it down by each sector in the overall debt sector, uh, all of them are bad. So credit card 90-day delinquencies are up. It's well above the long-term average, and it's sitting around 12.7%. Auto sector, you could make a whole video on just the auto sector. I think this is probably the worst. Subprime auto is particularly bad in loans right now, but it's up 3.89. It's up from 3.89 to 5.17 in quarter four 2025, but the repossessions are where it really gets tricky. So the repossession volume is the highest since the great financial crisis. There are a lot of people, especially at subprime, that just are defaulting on their loans, and the extend and pretend is kind of running out. Buy now, pay later is a big one. This is sort of a new thing post great financial crisis. Klarna, Afterpay, uh, it's just debt. It's just debt. It's not something new. It allows people to extend beyond their means. And one thing I do want to point out here, because I do want to go through the counter arguments, delinquencies and default rates on buy now pay later look great, and that honestly should make you think, okay, why is credit card 90-day delinquency sitting at 12.7%, but buy now, pay later, which definitionally you're gonna have people, uh, that are a little bit riskier to lend to, why are they sitting at less than 1% default rate? It seems very good, and I'm kinda gonna go into this a little bit. So from Lending Tree Research, they actually surveyed buy now, pay later users, and asked them how many late payments they have, since you can't really trust these companies' data. There were 41% of buy now, pay later users making one late payment in the past year, and that was an increase from 2024. And then also, they're taking out more than one loan at a time. People are just forgetting that they're having buy now, pay later loans, and they're putting it on everything, which I'll go into on the next slide. This is the auto loans, if you wanted to look at a chart of that. Um, 25% of consumers are putting groceries on buy now, pay later. In my opinion, you would just only do this if you're stretched to your absolute limit. I mean, the bottom end of the K, and I'll go into the K-shaped economy later, but the bottom end is just really struggling right now. Um, yeah, student loans, this one blew me away. I didn't know what I was going into whenever I looked into the student loan stats, but I found this crazy stat that just recently came out, I think February 2026. Student loan delinquencies have spiked to 25%. And this is 30-day delinquencies have spiked 25% compared to 9% in 2019. And by the way, this spiked to 25%. It didn't go up 25%. And this is from the Century Foundation. Just a fair warning here, we'll go into it later because I actually looked into how they sourced this data. Um, but they are a partisan organization. I just want to say that this isn't like a completely nonpartisan data collecting place. And things I want to talk about in payment loans in general is that the payments, again, were paused and they've recently started around 2025. I think it was late 2025, I may be wrong there. So people are having to pay these again when they were already, seeing default rates and delinquencies spike in all these other debt sectors. And student loans, just want to remind you, are the most insidious type of loan you can have because if you don't pay your student loan, they will garnish your wages. They will take your pay and out of your paycheck to pay that loan. And even if you declare bankruptcy, it does not wipe your student loans. In housing, there's not too much of an uptick in housing, but FHA loans particularly are up a bit. And so I'll go ahead and show the FHA loans over here. But I did want to talk about the student loans back here. So actually did make an inquiry to the Century Foundation because they went over their methodology to how they got the 25% 30-day delinquency spike. But their 9% pre-COVID rate I saw in other statistics, and I wanted to know if it was the same methodology. So I'll let you read their response to my concern over here. And I thought that they were very transparent. And I actually have a lot of respect for how open they were and how quick they responded. And I do trust that data now. So I would definitely see that as a worrying sign. But what does this mean for the consumer? So we know that defaults, delinquencies are up. Consumers are obviously feeling some sort of stress, but let's get some data on the consumer. 69% of Americans say they are living paycheck to paycheck, and this is up from 50%. Again, this is a survey, this isn't hard data, but that's a concerning jump. It's up 19% from 2023. People clearly aren't feeling good. The University of Michigan Consumer Sentiment Index is highly regarded. It's sitting at 55.5 in March. And just I know this number means nothing to you if you don't have some context for it. So 84 to 85 is thought to be normal. This is like a normal economy, not booming, not terrible. And this was a drop from 79.4 to or dropped from 79.4 in March of 2024. So that's a pretty substantial drop, and I'll show the chart later. And then for reference, in November of 2008, right before the big stock market crash in 2008, consumer confidence was 55.3, extremely similar number to what we're getting right now. And then consumer spending has remained resilient in GDP, and I just wanted to point this out because people will point this out. The consumer says they're doing bad, but they're still spending like normal. So we don't see any risk to the economy. And I just want to say we are in a K-shaped economy. This means that some people are doing very poorly and some people are doing well, and this largely comes from the fact that, uh, high net worth individuals typically keep their money and assets, like the stock market. And, housing, the stock market, it's been doing very well in recent years. They feel wealthy, they're spending. And people that are, getting most of their money and savings from income aren't doing as well. And then I also wanted to say that the bottom part of the K does have more access to debt than ever before. So that could be another reason that consumer spending has remained resilient. So this is the University of Michigan chart I was talking about. You can see it's really strong pre-COVID, sort of dips in COVID. You can see June of 2022, it drops to around 50. That's the lowest. Kind of bounced off of that, and now it's just been trending down ever since. Um, yeah, so I'm going to move into employment now, and then hopefully we'll talk about why employment and the consumer are interconnected. So I'm going to sort of play out the bear case, and I really want to show you what's going on in this chart because I think it's very it's very good to look at sort of how this chart moves over time, and I want you to just pick any point, any point, any high point, any peak on this chart at all. And you can see that it spikes up very rapidly. And the moment that it starts trending down and going down to a bottom, as soon as it bottoms up, it goes like straight into another recession. These gray lines are recessions, these gray areas. Um, and you can see post COVID, it starts trending down pretty gradually. We bottom out, and there's been no spike yet. So I did want to just point out this is kind of irregular. You can see 2008 is a great example. You can see we get this spike, dot-com bubble here, goes down. The second it starts to bottom up, you get this big spike up. Okay. So what's going on in employment? Let's look at the data. I say this is the bear case, but this really is just a lot of accurate data. Um, So in 2025, we got an initial estimate of jobs added at 584,000. This was revised down to 181,000 jobs. So it's a big revision downwards. And 181,000 jobs in a whole year isn't very strong when you need jobs to be added each month just to maintain the current unemployment rate because of the new workforce coming in. So in February, we got a headline jobs number of 92,000 jobs lost, which is a really, really, really atrocious headline, especially since the way that these revisions kind of worked and the jobs numbers have been working for a long time was, you'd get a headline number, let's say it's 100,000. Uh, People would say, "Oh, the economy is doing great. Employment looks great." And then in that same paper, you'd scroll down to the bottom. The past 2 months have been revised down by like 60,000. So really, you didn't add that many jobs. And then the next one, that initial 100,000 would also get revised down. So to see a headline 92,000 jobs lost is pretty brutal, I would say. One thing to point out is that this is a low hire, low fire economy. This is particularly dangerous. It means nobody's really hiring, but nobody's really firing either. So the employment rate back here is kind of staying steady, kind of gradually rising. But at any moment, if there are mass layoffs or if people stop, um, maintaining employment and actually start getting rid of workers, the unemployment rate can spike very quickly because nobody's hiring at all. Um, yeah, in January 2026, the highest number of announced job cuts for any January, I think this was, Challenger Gray and Christmas has been doing some layoff reports, particularly concerning. And then I just want to point out, every single sector of employment is contracting, besides healthcare. In 2024, when you were reading the jobs reports, it would be like healthcare and government are the only two places where we're seeing job growth. After Doge came in, just healthcare. And in this latest one, we actually saw healthcare contract as well. Uh, you can talk about the gig economy, Uber, Lyft, that sort of making the data a little bit harder to read because this wasn't really a thing for a long time. But now, you get laid off, you have all these different gig jobs, the gig economy, you can go and get some temporary work. Let's just get an entire economy full of Door Dashers. Um, but I did want to go over the the bull-ish case, and the reason that I call it the bull case, and you'll see that the common theme here is that even in like the best case scenario, it's just sort of like things stay flat, they stay sideways. This sort of chart again, I know I keep going to it, but it just sort of like they're arguing that it's just going to continue going sideways forever, which you can see just never happens in history. But to be fair, this line is regular to begin with. Um, so another thing that's kind of I guess, going to make it harder for the unemployment rate to go up dramatically is that the immigration policy recently has reduced the jobs needed per month to maintain the current employment rate. So essentially, there are less workers in the workforce. We're removing workers, so then there's actually less supply of workers. So then it just makes it harder for the unemployment rate to go up. The Fed numbers in this last jobs report are supposedly because of a healthcare strike. So we could see a counter surge in the March numbers. So I'm not gonna discount that. That might be right. Healthcare might continue to be the only strong push, the only part of the labor market that's not contracting at the moment. And then again, I think I've touched on this enough, but it is particularly irregular to see that the unemployment rate stays so flat for so long after a bottom out. After the bottom out is the key word. So you can see like September 2008 was the bottom out, and then or sorry, September 2007 was the bottom out. April 2008 was when you saw that big uptick in unemployment, and then we've sort of seen a 3 year bottom out and rise, which is very strange. But I want to talk about how it's not a vacuum. Um, and this is something I'm gonna be harping on this whole presentation, is people look at the debt sector and they say, okay, yeah, the default rates, the delinquencies are rising, but it's just going to continue to stay there. Nothing's going to impact it. But we know from the typical business cycle is that when consumers feel weak, right, they pull back spending. Businesses don't sell as much, they lay off employees, and then more consumers pull back because if you just got laid off, you're not going to go out and spend, which leads to more layoffs. So whether the layoffs come first or the consumers feel weak first and pull back spending, it doesn't really matter. What matters is that they work together to create a downwards force. So if the labor market is weak, that's an extra risk for the debt sector and vice versa. So let's move on to oil, because this is another big thing that just came up. So as of right now, I think that WTI is like around 98, but I'm just gonna put it at 95-ish because that's where it's been hovering the past few days. Brent crude is around 110 right now, but I'm gonna put it at 100 for the same reason. The Strait of Hormuz is the key thing. If you don't know anything about this war or geopolitics, what you have to know is that this strait right here is where 20% of the world's oil flows through, natural gas goes through here. A lot of key ships get into these Gulf region where you have, Qatar, Saudi Arabia, UAE, all these different countries are providing things that need to go out and get into the world economy. And oil is a big one. So let's just talk about the impact of oil first before I go into like best case scenario, worst case scenario. Uh, we're seeing already, prices at the pump go up, but I want to talk about food and grocery because this has been a big issue talked about is fertilizer trade. So all of these components of fertilizer here, sulfur, ammonia, they pass through the strait. Uh, 1/3 of the global fertilizer trade passes through the strait, and so when that's cut off, you're going to see fertilizer spike. And I believe this is a particularly bad situation because oil is also a key input in in production costs of fertilizer and pesticides as well. And there's a lot of crop growing seasons about to come up, so this is just like the very poorly timed. But then for the consumer, diesel prices going up also, you know, the transportation costs pass to the shelf. So essentially, the trucks that deliver the food to the grocery store are going to pass that cost. The grocery store is going to pass it to you. So that's one way that your food and grocery bill might go up. At the pump, should be pretty obvious. You spend a lot on gas. A multi-dollar rise per gallon of gas is just, yeah, it's gonna cause a strain on the consumer who's already doing bad. Uh, so prices at the pump decline farther out than oil. So this just means whenever the price at the pump goes up, it sort of lags behind oil and it goes down a lot slower. So if price of oil goes to 100, and then gas gets to $4, let's say, the gas stations are going to decrease the $4 number far slower than the oil number. So if it goes to 80 the next day, gas prices will still stay elevated for probably weeks or months. Transportation is going to be impacted, and this is a big one because it's going to affect airlines, the entire trucking, shipping, uh, global industry. This is a big problem, and then we're going to see inflation tick up to around 3% from this probably. So this is the national average AAA fuel price for today, and you see that it's up to about 3.9% in the US, or sorry, $3.9 per gallon in the US. And you can see like a month ago it was 2.9. So it's pretty much up a full dollar. And then you can see diesel is particularly up. It's up over a dollar. And so that is starting to really impact truckers and just make things a little bit more expensive every single trip. So the longer this goes on, and that's kind of what I want to talk about, is the best case scenario is that this wraps up extremely quickly. This wraps up this week or next, and that's what's priced in for oil right now. Is that this stops immediately? Iran stops blocking the flows. No new conflict. No instability caused from this sort of like turns into something else that could send prices higher or create a risk premium. Oil prices fall back down to around 80. They're not going to go back down to 60 because there is some risk premium that's just going to be inherent with a conflict like this, and then it'll slowly drift back down. And then, like I said, gas prices peak close to 4, and then they slowly drift back down. If oil slowly drifts back down, this drifts back down way slower. And then the worst case is that there's prolonged involvement. We put boots on the ground. We fund an insurgency. Uh, or we do an irreversible action. We bomb their energy supply. We bomb Karg Island or something, and accidentally hit their oil production, or intentionally hit their oil production. We seize Karg Island. This is all speculative, but this is the worst case: is that oil explodes. Again, $100 a barrel is pricing in this ending right away. It would explode above $100 a barrel if anything irreversible or prolonged occurs, and it would turn from like a brief oil spike that's going to be a drag on the U.S. economy to an oil shock, which is going to push the economy down by force. Um, and then I just really want to talk about how this is not in a vacuum, and these three things are all tied together in a negative cycle. If you have less discretionary income because you are spending more money on gas, the consumer is just weaker. And we've already talked about the business cycle, how a weaker consumer leads to higher unemployment, businesses struggling. And then you also have higher transportation costs, weakening businesses, and it could just be a catalyst. You see in a lot of the recessions in the employment graph were caused by oil shocks. It's just such a powerful driving force to the economy. Um, so yeah, let's get into private credit and private equity. So big disclaimer here, just out of the way. Private credit and private equity are opaque. They are very difficult to get eyes on because they're not listed on a stock market where you can instantly see, valuations of the portfolios. Valuations are based on models that these companies provide, not actual sale prices. Investors get reports, so we don't get reports. Only investors do, and reports are still vague, even for investors, and they can handpick stats from the company that make the company seem like it's doing better than it is. There's very limited regulation on reporting. Again, this isn't a publicly listed company, so the SEC isn't looking over all of these and making sure that the standards are perfect. And again, not only is this opaque, it's complicated. Private credit and private equity are some of the most complicated sectors of finance that you could imagine. It's so hard to wrap your head around this, and that's why it's particularly dangerous and hard to understand. So some context for private credit, private equity, it's estimated at around 1.8 trillion, and then a lot of private credit is tied up in private equity. So, some people like to say, "Oh, I'm not worried about private credit," but if you are worried about private credit, you should really be worried about private equity because if the equity is no good, that's when private credit would actually be impacted. So I do just want to sort of explain. I know it's a complicated system. I'm going very high level here, and I'm actually going to borrow this chart from How Money Works, who I think borrowed it from the FT. Um, but I'm going to try and explain a little bit of how this works. So the private equity fund is going to take a mix of investor money and their own money to go and buy a real business. And the way this used to work was these businesses were solid, undercapitalized businesses, and you combine the market experience and the you know uh, skills that the business owner has with the private equity fund's business acumen to sort of team up and turn this business into something way more productive, and it would beat the market and things would be great. So the way private equity works is you take this money from the outside investors and private equity itself, and then you use debt to finance the rest of the buyout. And then the debt actually goes down here to the real businesses. So the real businesses own the debt. They own this is on their balance sheet. And so what they're essentially having to do is not only grow as a business, but also pay off this debt that they owe, which was just the buyout of themselves. And so banks actually kind of stopped being the primary vehicle. You see a big increase in private credit funds, which are acting as this sort of debt to go to the real businesses recently. But private credits also borrow from the banks. The banks, I don't want you to think that they're totally disconnected from this now. And then the concept of a secondary fund is important. So essentially, there's a liquidity mismatch between businesses because essentially private equity owns a portfolio of businesses. And if investors want their money right away, they the private equity fund can't just go and sell a business instantly to give this investor their money. So a secondary fund is just essentially a way to pay out the investors without sort of having to sell these actual businesses. And this concept of a portfolio of businesses is something else you need to know because essentially instead of doing the traditional way of getting outside investors and PE managers to go and combine to get this debt from the bank to go buy a business, what they can do is they can sort of use this portfolio of businesses and get what's called a net asset value loan or a NAV loan to essentially say to the bank, "Hey, look, we have this whole portfolio of businesses. Give us a loan based on that." And this is particularly dangerous because this is where leverage can get stacked, and this is where leverage multiplies. And so there's essentially you're taking out debt based on a bunch of companies that are also saddled with debt is the main thing you need to understand. Um, and I just want to kind of give the overall theory about why people are concerned about private equity right now. So around 2008, you see, or around the Great Financial Crisis, you see this big divergence in PE net asset value and in the public market cap. And what I just kind of want you to understand is that pre 2008, investors saw a functional system with good returns, which was mortgages to creditworthy borrowers. And then you had a mortgage backed security to spread the risk around. And so all this capital came in. And what ended up happening is that the underwriting got worse and the loans went bad. But you need to understand why the underwriting got worse. It's because there is a limited pool of creditworthy home buyers, and this is being competed by all of these different lenders to go and give all these people their loans, and there's only so many creditworthy borrowers to go to. So as it gets more competitive, you either have to uh, loosen your standards, your lending standards to keep it going, make riskier loans, or you can sort of take the returns and accept that they're going to go lower, the yields are going to go down, and then less cash is going to go in. And so that's what happens whenever you put a lot of cash and capital towards something, is that they're incentivized to worsen the underwriting. So post 2008, investors flock to another functional system, private equity, where you invest in solid, undercapitalized businesses. Like I explained, returns are solid; they actually do beat the market. But the pool of solid businesses is limited. It's actually actively shrinking because you're buying them up. There's more competition. The private equity firms are outbidding each other. They're selling to other PE firms. And so you sort of have this flipping business going on where you don't even make improvements to the business, you just buy it, load it with debt, and then sell it to the next PE firm for a higher rate. And I just want to point out the only thing that matters here is whether the loans are good or bad. Just like in 2008, if all the loans were good, you just had more capital, more returns, everything was great. But the loans were bad. People could not pay these loans. And so all that matters here is whether or not there's equity in the companies, whether the companies are actually going to be able to pay off this debt is the real question. So let's look at some of the recent headlines in private credit and why people are worried. So private credit defaults hit a record of 9.2%, up from 8.1% in 2024. Blue Owl, Blackstone, Morgan Stanley, BlackRock, they're all gating or they've capped redemptions, which just means people are trying to pull out their money and they can't. They're not allowed to. And again, this goes back to the liquidity mismatch. So these businesses are very illiquid, they're hard to sell on a dime. And so that's why secondary funds exist. And so what a bull might say is, oh, of course they're going to be gating and capping redemptions. If everybody's trying to pull out at once, there's a liquidity mismatch. They can't sell all these on a dime. But what people are speculating is that the reason that they're not selling all of these on a dime is because they know that the losses they don't want them to be realized, and the equity is actually no good. So another thing that's interesting here is this payment in kind uh, interest income. So payment in kind interest income surpasses 1 billion for the top 15 BDCs. This is just private credit, and I actually had to look this up. I had to figure out what payment in kind interest was. So essentially, borrowers pay their interest with additional debt. This was absurd to me. It's like if I took out a mortgage for 300K at like 5%, and instead of making monthly payments on time, adding up to 15K for the first year, if I just said, I'm not going to pay anything on my mortgage for a whole year, just add it onto the debt. Just make it a 315K mortgage instead, and then you owe more the next year. So this is a sign of distress for, or at least that's how the bears take it, is that this is a sign of distress, is that payment in kind is 8.7% of total interest income. That means that a lot of people are not paying their debt and just adding it onto the pile. And then there's also this concept that they're exposed to software. There's been a recent software sell-off due to AI concerns that you can just vibe code an app or whatever and replace this software company. Uh, and then something I want to point out is that there's very limited recovery value here. If the loans are bad, in 2008 the banks ended up with uh, thousands and thousands of homes that still had value, like they were still homes. Uh, these software companies, uh, code does not have any inherent value if the business goes under. So that's something I wanted to point out. And then here is a very blurry graph of all the different private credit funds and their stocks. You can see people are very worried, very volatile, going down overall, not very bullish in the private credit funds. Oh, and I did want to give a huge shout out here for Morgan Stanley, who not only took big losses in 2008, but also somehow managed to find their way into the private credit potential blow up as well. Just astounding work from them. Um, so I wanted to do another. This is not a vacuum. You know, private credit does not exist independent of the overall economy. Um, So small, medium-sized businesses have increasingly benefited from private credit. They get easy loans, bigger loans than they would traditionally get from bank. Flexible financing. They can pay it off in very convoluted ways, which private equity and private credit are great at. Uh, and then I just kind of want to go over the cycles that we're talking about. Businesses struggle from a weak consumer. There's tighter lending in the business cycle. There's higher input costs from oil, right? Loans go bad, which leads to even tighter lending, which means that more businesses struggle to get lending, so they struggle. Unemployment rises further. Consumers are weak. This all compounds. It's just one big pile. So whenever you say that private credit is not doing well, uh, and then somebody says, "Oh, private credit's probably fine." What you gotta understand is there's another drag on private equity and private credit, which is the rest of the U.S. economy. And another thing I wanted to touch on here, which I didn't include, but rates are higher. These companies are, if you're doing payment in kind interest, like you're having to refinance the loan at a higher rate because rates are just higher and more elevated than they were whenever a lot of these loans were made. So you essentially have to take out the loan at whatever the you know short term or long term yields are in the current economy, and then you also add a risk premium on. So people were getting loans at like 3 to 5% because rates were practically zero for a while, and there was just 3 to 5% risk premium, and now that rates are like 3, 4. You're getting like 9% loans on these companies, and so the interest is starting to eat away at them, and you can only do this payment in kind interest for so long before you just go under. Next, I want to talk about AI. And there's a lot to go over here. This is probably the one that I'm simultaneously most knowledgeable on, but also there's just too much to talk about. So in 2012 to 2020, there was a lot of research development on both scaling and then transformer architecture. So the big papers that I'm kind of trying to draw your attention, there's a whole lot of research here, but the big ones are in 2012. You essentially had a paper come out that showed, GPUs were way to train AI models way faster than before, and throwing more compute at a problem led to better results, and that sort of challenged the industry, knowledge at the time. And then 2017, there was a big paper on transformers, which sort of paved the way for GPT, in 2020. And then you saw GPT's exponential increase. Uh, so you see in GPT-3 2022 of November, they put 50 million towards that, and you saw like a big improvement from GPT-2. So then for GPT-4 in 2023, they put 500 million towards it. You saw another exponential increase. They just put more money at it, more compute. The model got better. So for GPT-5, they planned to spend 5 billion, and then that ended up falling through because they realized that it just wasn't going to be enough. It wasn't worth the money. It started to show some diminishing returns, as I put it here. And then there's been a really recent research focus. People have just been going back to getting sort of incremental improvement, slight efficiency improvements to training, bringing the cost down. You've seen DeepSeek really making big strides here. And then I want to talk about the risks. I'll talk about AI risks a little bit more extended. So I just want to go over like data center and GPU. There are funding risks. Private credit is involved. If that funding slows, things could break. There's logistical risks. Data centers. I mean, these GPUs that you're having to power and run on maximum capacity, they're hot. The cooling technology is incredibly complex. These data centers are massive. There's just a lot of logistical risks that go into it, and then profitability is a big one. Like if you're actually running this GPU full time, how much money is it going to be making based on the AI usage? How many people would have to be renting out this AI for it to actually be profitable? Um, and then the GPU side of things, where you have research advancements that could make GPUs obsolete. You're building out these huge data centers and you're building out all this GPU capacity, and then something comes out where AI can be trained on a different architecture entirely, and then that could go up in flames. As well as competition, Google is training their models on TPUs instead. China's sort of building competitors to GPUs from NVIDIA. It's just there's a lot of risks in all of these, and I'll kind of get into it here. All of these are interconnected. They're interconnected risks, right? So if there's an AI risk with where OpenAI starts to struggle, I mean, they have spending commitments to Oracle and NVIDIA, and all of these things are impacted when one of them goes down. If Oracle can't build out the data centers on time, or if they can't build out the data centers at all, or they lose funding, NVIDIA is getting money from them, OpenAI is getting money from them. that whole cycle of money starts to break down. And then there's also the concept of artificial evaluations. So this money is just getting passed around. It's sort of the same capex, but every single time it was getting passed around, was leading to stocks going crazy. People being like, "Oh wow, look at all the revenue that OpenAI is getting," and then you look under the hood, and it's from Nvidia, or it's from Oracle, or vice versa. So I want to talk a little bit more about the AI risk, because I think that there are inherent architecture issues that people don't really address, and it's that AI, as it stands, LLMs, in their current form, really struggle with problems not in the data set. And there's such a difference between, you know, being able to logically explain something. Like AI can explain, rules for logic, or how to complete logic problems, and it'll give you a great answer because that's in its data set a thousand times. But then if you actually ask it to to do a logical puzzle, if you make it confusing or it's not in the data set, it won't be able to do it because it's not actually applying uh, the principles that it quote unquote knows whenever it answers the first question. It's just looking for stuff in its data set and then repeating it. Um, and then because of that, sort of to expand on that, it really struggles with complex tasks. If it's not like a very pattern recognition heavy task, it involves multiple moving pieces. It's that kind of stuff is less likely to show up in the training data at all. And then there's this concept of knowledge cost, which is where if you have to give it 1,000 problems all completed correctly in a data set, humans clearly know how to do it. It's more of an automation tool at that point, being able to do it at scale that AI provides, which all this stuff is priced in that AI is going to completely be able to do all of these extremely complex tasks with no problem. And if it's not good right now, just wait till this year or this year or this year. But it's time sensitive because of all these spending commitments uh, that have to they have to come to fruition eventually. And then there's a ton of competition. So there's domestic competition, particularly for OpenAI, where you have Google, Anthropic, Meta, XAI, all these different domestic competitors that are training their own foundation models, and Google and Anthropic are right on their tail, especially with Google and multimodal, and then Anthropic is actually uh, really pushing hard in code and general language reasoning. Uh, and then the foreign competition with Moonshot and DeepSeek, this is a big one because it's research heavy, which is where AI is headed. DeepSeek has put out amazing research papers, just actually changing how people think about how to train AI. And then they're way cheaper, mainly because they're just sort of distilling the models from Google and Anthropic, but they're always close behind. They're always going to be 90% as good and 90% cheaper than the foundational models. So it's very scary. It's like for OpenAI, how do you build a moat? How do you make sure that nobody can catch up to you whenever there's all this competition and people can just distill your model at any time? I think it's a big risk. Um, and so I just want to again show this isn't in a vacuum. The upper part of the K is at risk here. Uh, a big part of why the upper part of the K hasn't been, I guess, dragging down consumer spending. They've been making the bulk of consumer spending, is because people feel wealthy. They feel wealthy from the stock market. If stuff starts to, decline, their portfolios don't look as good. They may pull back, and then it adds to that cycle where, uh, the businesses collapse, and then it continues to go down. It adds to the business cycle, which is where consumers get even worse, and then things sort of pile down that way. There's private equity and private credit exposure. Blue Owl's investing in these data centers, and they might not be doing so well. OpenAI has investment from private equity and private credit. So if that blows up, that could be another reason that OpenAI isn't able to fund this sort of continuing investment into Oracle and Nvidia. And then employment as well. If there were some sort of bubble pop, all of these companies go down. There's layoffs, and then it adds to the cycle that way. I've gone through a lot. I'm kind of tired, but the conclusion here, and again, this is not financial advice. This is not something I'm gonna just give you, oh, you should go all in on this. I think there's a recession incoming. You can see the source there is very legitimate. Something I'd like to highlight is that not only are all of these risks not in a vacuum and they're all so intrinsically interconnected, but also the best case scenario for most of these, like oil, is just that things are bad, but not as bad as they could possibly be. The case for employment is that, oh yeah, employment is trending upwards, but hopefully it just stays still, which is not what the data shows, and it's also not arguing that it's going to go down. The debt sector, it's like delinquencies are rising, but it's like okay, it'll stay contained in that area. Nobody's arguing that it's going down. And so if even one of them are right and they're all interconnected, it's going to push the rest down by force. The only one that I will say that the bull case is, and not saying that I think that the bull case is likely, but that the bull case is actually arguing that things will get way better is in AI. People can argue that AI is going to completely change everything. There'll be, AGI is going to completely take over the workforce, which I don't know if that would be a particularly good thing, anyways. But what I expect to see, I expect to see a recession incoming. I don't think that you can stop the business cycle. I think that you could keep investment coming. I think that you could, you know, lower rates, keep private credit and private equity up afloat a little bit longer. I think that you keep the debt sector going a little bit longer. I don't think that you can stop the business cycle for that much longer. I think the business cycle is a, the weakest link in my opinion, or I guess the hardest one to stop in my opinion. So with that, you're likely to see rapid rate cuts in QE. I just think that it's going to tear down everything else when it does, and you're going to see rates go to zero and QE, unless there is a huge Iran change. I think that is the only thing that could stop this. Um, yeah, and with that, you're going to see the debt expanding. You're going to see bond yields push higher, particularly uh, long term bonds, which are separate from the federal funds rate, as well as the yen carry trade pushing things higher. I think people like to sort of make the case, oh, it hasn't happened in the past, and so it's not going to happen now. But Japan is in a tough spot, and I don't see that their debt is going to get more sustainable somehow. And so the yields will continue to push. They've been artificially keeping them low. Um, Bonds might push lower in the short term if we cut rates to zero, but I think the long term trajectory is going to be a push higher if we keep expanding our debt. So what should you do? I've made changes to my portfolio, but I don't think you should do that because you watched my poorly put together YouTube video. So I'm just going to give you general recessionary advice. Don't quit if you have a job, unless you have another one lined up and it's great and stable, and you really have thought long and hard about it. I would not just quit and just hope for the best and try and find a job right now. It's very difficult. Again, no hire market. I would build some cushion. I would try and save up uh, at least 6 months living expenses. Think about what would happen if you did lose your job, how that would affect you. Try and get you know don't put it in risky assets. Just a high yield savings account, CDs, whatever you need to do. Pay off high interest debt. If you have a high interest student loan, an auto loan, you're never going to regret it. You're never going to be like, oh man, I'm so sad I paid off my debt instead of spending recklessly into a downturn. And then I would just challenge you to pay attention, to just continue watching videos like this, or watching reading news, reading books, trying to just understand the world better, and how all these markets interact. I'm not saying that everything I said is gonna happen exactly as I said it was gonna happen, but I think that it's important to be informed and to make predictions like this, and then see how it stacks up with the real world. So yeah, I wish you guys luck out there, and I hope I'm kind of wrong about all of this, but I don't think I am.